All right, ladies and gentlemen. How you doing? I am Stan, the finance man, and today we're getting a little bit more in depth into some serious topics. We're going to talk about what the GOP Trump tax bill means to you. So, how can we survive? Now, it's a lot of myths going on, a lot of rumors, a lot of good and a lot of bad. So, my job is to teach you, my people, how we can benefit off whatever. See, now, my philosophy is money. Money's never lost. Money's just transferred. So this side might get money, and then they fight with each other. Then the other side wins, and then they get the money to pour down to them. So what does that mean for you and I? We have to get the money we have to find a way for us not to get woven out and take a big loss while these changes are happening and they're gonna occur. So let's break it down. All right. Now, if you own a home in 2018, what does that mean for you when you file your taxes? Well, normally you're able to write off a significant amount for your mortgage interest. Now, for those who own homes, you know what I'm talking about. You gain mortgage every year when you pay your payments. So as much as you pay, as much interest goes back onto your loan. You can write that off because that's money against you, right? Well, they capped it off at $10,000. So for some of you with really large homes or really large mortgages, you know, $10,000 is going to be the max. That's a big change for the year. We're also going to talk about the personal exemption. That's gone. That's gone. Now, I'm going to give for the people that don't know what that is. When you file your taxes, you have what's called a standard deduction. Okay? And then you have a personal exemption. Alright? So, if you are a single person and you're a single person and you made $10,000 for the year, okay, you're a student. Well, based off of you being single and you're not gonna write off anything, you don't own a home, you just got your money and that's it. Whatever you made for your W-2. Well, that's called a standard deduction. You're not gonna write nothing off. So about $6,300 and change. We're just gonna keep it $6,300 for the sake of keeping it simple. They're not gonna tax you on. They're not going to tax you on the whole $10,000. They're going to remove $6,300, or it's not going to get removed, but it's just going to be a free amount. They're not going to tax you on. Now I want to make sure that's understandable. Okay, so whatever's left, which is $3,600, that is, that's what you should be taxed, right? But no, there's something called a personal exemption, which is about, we're going to say $4,000, to keep it simple. It's $4,000. And that's per person that's in your home, okay? So you're not going to pay taxes on $3,600, all right, because you have the personal exemption. So we're going to reduce what was left from what you made from the $10,000. So really, if you look at it, you're negative $1,600. Okay. So how much money did you make for the year? Well, or how much money is taxable from $10,000 for being a single person, based off of our calculations? You're negative $1,600. All right. So if you pay $980 from the federal income taxes, you're going to get that back. You have no tax liability. See, this is how you get your refund back. All right. So these are the numbers. Now, what if you have children? Well, this $4,000 here is for each person in your home. Okay. So if you have 2 kids, that's $12,000. So even if after we did the standard deduction, your income was $3,600. Well, you're gonna have to change this 4,000, okay, and it's gonna be 12,000. So you just be still negative, but it wouldn't make any difference. You would get this tax refund back. Now, based off of the earned income credit, of course, you would get the max earned income credit, the max, and for this income level, you would get the additional child tax credit. So you get the max. You have a pretty nice refund based off of you being at this income level and with the amount of children that you have, or dependents, per se. It may not be your kids, but. So, this, bottom line, this personal thing is going away. Okay? That's gone. But what did change is that this 6,300 of the standard has now doubled. Okay? So under the Trump bill, it increased from 6,300 to 12,600. Okay, which is a good thing, but you don't get that $4,000 for each person in your home. So if it's you and two kids, this is all they're gonna. The 12,600 is the only amount that is not taxable from 10,000 or whatever. You make 30,000, same difference. Okay, but you can see clearly the more you make, how that'll affect you. Okay, so that exemption is gone. So there's no more putting on. Your mom live with you. You get that exemption credit. That's gone, which is a lot of people are not happy about that. But now at least you know what you're looking at. Okay. Now let's see here. This mumbo jumbo. This is pretty much. You can no longer deduct casualties and losses or none of that stuff. Unless they're in a wildfire, hurricane area such as what we were in Florida or Texas, or Hurricane Sandy hit New York, stuff like that. But other than that, if you take a loss, you can't claim that as a loss on taxes anymore, unless you're one of those declared disaster areas, which is a big change. Okay. What else we have here? A really good thing is if you have kids in private school, you really couldn't do nothing with the money you spend. But now you're able to save towards that. And there's something called the 529 that a lot of people would use to save for college, but you can also use that from K through 12 education tuition. So that's a real big thing. So if you want to learn more about the 529 plan, you can Google it. But that's a good thing for those of us who have children that are attending, or you are anticipating them in attending private schools, K through 12. Okay, let's see here. The mandate for the Affordable Care Act. So, as you know, for about 2 years, if you didn't have insurance, you would pay a tax penalty of some sort. Well, that's gone. You're not mandated to pay that amount anymore. You don't have insurance. You just don't have insurance. I don't know how that's going to affect people. Maybe good. A lot of people were unhappy about paying that amount, but it depends on where you're at. Let me see here. A lot of the tax brackets did go up, so a lot of the tax percentages, it will be better for the middle class. It will be better, but it is temporary. So in about 10 years, it's gonna go away. So that's something to keep in mind. But you can take advantage of it for a while. And you can look online for the actual tax brackets that gives you the amounts. How much are you required to pay based off of your marital status, and based off of how much money you made. I'm not going to go through that whole tax bracket with you, but you can look it up. For low income housing, no changes. No changes. So pretty much the same. Oh, this is important, and I'm gonna talk about this a little bit more. But if you are a business or a pass-through business, a pass-through business pays taxes through the individual income tax code rather than through the corporate tax code, which are sole proprietors, S corps, partnerships, LLCs, are all pass-through businesses. C corps are not pass-through; that's an actual corporation, as we know. According to New York Times, nearly 40 million taxpayers in 2014 claimed pass-through income. So a lot of people claim LLC, claim sole proprietorships, and things of that nature, S corps. Okay. Under the new tax code, pass-through businesses will be able to deduct 20% of their business income, which will lower their tax liability if they are in a higher individual tax bracket. However, professional service businesses owners such as lawyers, doctors, and consultants filing as singles and are earning more than $157,000 or filing jointly earning $315,000 face a phase out and a cap of their deduction. Other types of businesses that surpass these earnings thresholds will see their deductions limited to a higher of 50% of total wage. Sorry about that. I wanted to get that out the way. Okay, well, it's a good thing. Independent contractors and small business owners will benefit from the pass-through deductions, as will large businesses that are structured as pass-through entities, such as hedge funds, investment firms, manufacturers, and real estate companies. So these are large corporations. Of course, you know, if you have a real estate company, if you're in the hedge funds, you know, you're a large corporation, but you function kind of like an S corp or something like that as far as how you file. I'm going to be going over your head. Let me get back to the simple people like myself. These are intricate things that have nothing to do with me. And but if you need more breakdown on that, definitely email me, and I will break it down for you. Okay. Tax reform changes. The U.S. corporate and tax system for worldwide one to another territory. This means U.S. corporations will no longer have to pay U.S. taxes on most future overseas profits. Okay? Alright, that's pretty simple. That's simple. You know, make that money, bring it back home. Alright? If you're unemployed, Republicans say the tax bill will create jobs through lower tax rates and pretty much what they're estimating is that if you don't have a job when you're unemployed, this bill will give you lower liability, lower tax rates, and they say it'll give jobs because now bigger corporations are able to save more money, so they're able to give higher wages to their employees and able to open up more jobs. Some economists say this is not true. I don't know. This, you know, we never know until it happens. But like I said, my job today that I'm giving to myself is to break it down so you can get your stuff in order. If you snooze, you lose. And what we want to do is we want to give you the information, so hopefully you take advantage of the information and you don't get caught lacking. And you know, all I want to say is this: in January, welfare reform is up for debate. I'm not on welfare, but I know that the system has been around for a while, and a lot of people are on welfare or receive Medicaid benefits or Social Security benefits. Well, there's going to be a deficit of I think 1.3 trillion or 13 trillion or something like that created due to this bill. So they have to take the money away from something in order to pay for this bill. So they're looking at welfare. They've been looking at it for a while. So if you are getting SSI or SSA, you know, Medicaid, Medicare, whatever, you need to look at something. You need to look at what you're gonna do. If you're getting welfare, people who agree with this bill say that they're gonna try to create different programs. So if you are getting these benefits, they can give you job training and eventually get you off the programs. So it'd be good in that way. Some say they're trying to get rid of funds that a lot of senior citizens and single parents and people that have disabilities may need. Ladies and gentlemen, prepare yourself. That's all I can tell you, and that's what I'm going to stress. If you need any more information on anything that I'm breaking down, do not hesitate to reach out to us here at info@trcplantation.com. That's info@trcplantation.com. If you want to reach me personally and ask me anything, that's Stanley Tillerin at trcplantation.com. I will leave my name. It's really long. So stay tuned and thank you for following. Subscribe, like, and hit that that bell so you can get all the notifications whenever we release a new video. Okay? Thank you, family.